I'm Anthony Smith, and you're watching the Chart of the Week. Hello and welcome to our weekly video. This week's subject is negative yielding bonds. Folks, Bloomberg has a chart for almost everything, and this chart shows the total value of global bonds that are trading with negative yields. And it's pretty clear that to kick off this year, that amount has fallen precipitously. This is a one-year chart, and the numbers are in trillions of dollars. So it's been above 12 trillion for much of the past year, most recently falling to about 5 trillion. Let's extend this chart to capture the last 5 years. And you can see this is a phenomenon that's been with us for quite some time. The amount ranged from 6 trillion to about 10 trillion back in 2017 and 2018. So just how long has this been going on? Let's extend the chart back to as far back as Bloomberg will take us. And it goes back to 2010, and you can see in 2014, that's when this really kicked into gear. And the pile of negative yielding debt peaked at the end of 2020 at around $18 trillion. And I wanted to provide a little perspective there by looking up what is the total amount of global debt, just to see what percentage is negative yielding. And it's a hard number to pin down, but let's say it's 100 trillion, give or take. So at its highest, at the end of 2020, negative yielding debt amounted to about close to 20% of total global debt. So that's down to about 5% currently. When central banks buy bonds, when they print money to buy bonds, this process bids up the prices of bonds. And since yields move inversely to prices, the yields have fallen and fallen and fallen to the point of going negative. So who is borrowing at these negative yields? It's not the U.S. Interest rates are very low here, as we all know, but they're still positive. The yield on the 2-year Treasury note is about 1.57% today. Let's look at where other countries are borrowing over 2-year periods. So this screen has a lot of info on it, but I'll use some yellow boxes to focus our attention. So these are 2-year bonds, and on the left side you have the country, the issuer, and towards the middle there is the yield on these 2-year notes. So let's walk down the list to see where these countries are able to borrow today. First, the United States is at the top where it belongs, and like I said, the yield on 2-year paper is about 1.57%. Okay, let's look at the negative yielders here. First, France is borrowing at about negative 30 basis points, so negative 0.3% for 2-year periods. Below that, we have Germany at even more favorable rate. Then we've got Spain borrowing at negative rates. Portugal is borrowing at a negative rate. Sweden, about flat, about zero. Holland, negative. Switzerland, negative. Greece is borrowing at a negative interest or a negative yield. And Japan, of course. So those are several of the countries that are able to borrow at negative yields. And I think, backing up a little bit, this concept of negative interest rates, it was certainly not part of my education. And I would venture to say that for most, if not all of you, you have not dealt firsthand with negative yielding bonds. Borrowers should pay lenders to use the lender's money for the period of time they're using it. I don't think that's too radical of a notion, but the opposite is the case in many of these countries today. So let's explore how negative yields work in the real world. And because there's a perception that the lender actually pays interest periodically to the borrower over the course of the loan or the bond. And that's not actually how it works. So let's use this 2-year German government bond to illustrate how it works. Again, lots on this page, but we are going to use some yellow boxes to help focus our attention. This is a 2-year German government bond. It was issued February 1st, so just recently, and it matures March 15th of 2024. So it's a little longer than 2 years, but this is considered a 2-year government bond. Now this is where it starts to get interesting. The coupon on this bond is 0. Why is that interesting? Because if you look at what the lender or the investor paid for this bond, they paid 101.066. So let's call it 101. So for our purposes, let's say that this investor or lender paid $101 for this bond. What happens in 2 years? Well, they get par or 100 back at maturity. No coupon, you pay 101, you get back 100. That's how negative yields work. And so the yield at issuance, when this was issued February 1st, was negative 0.5%. Negative 50 basis points is effectively the interest rate at which Germany was able to borrow for 2 years. So that's how it works in the real world. What should you walk away with today? And what I would say is the easy money, the money printing, the quantitative easing, whatever you want to call it, that has led to negative yielding debt globally, that's reversing course. And it's largely in an effort to fight inflation. And rising rates can be painful when they're happening, but do ultimately lead to a healthier balance between fixed income and equities as part of your investment portfolio, especially if fixed income actually generates income to supplement your daily expenses. That's it for this week. Thank you for watching. We'll see you next week.